I'd like to thank the LBS for organising a fantastic conference. And Soji has even managed to lay on the weather as well. You're missing rain and drizzle outside. It's just a perfect day for a conference. I'd like to introduce my panelists one by one. If I could start with Yvonne Ike. Yvonne, if you could come up. Yvonne has worked at most of the major banks across Africa. She's got huge experience in investment banking, and I think it's going to give us a lot of expertise about the investment banking side of the business. We also have Nicolas from CDC. CDC is owned by DFID, the UK aid agency. We just found out in the last 24 hours that the Conservative government is going to maintain the 0.7% of GDP aid target. And that has been very helpful. CDC is the private sector arm of UK development and plays a very big long-term role financing investment. If I could also invite Harold to come up. Harold works at Deutsche Bank. He's head of global transaction banking, which I've just found out means commercial banking. Real finance, as he says, rather than the investment banking stuff that Yvonne and myself do. He's based in Dubai, and he's been running Africa and the Middle East since 2013 for Deutsche Bank. And lastly, Faisal. He's at Riskura. This is a firm I know well. They advise pension funds in Africa that want to invest in Africa or globally, and also encourage global investors to come to Africa too. I'm Charlie Robertson. I'm the Global Chief Economist of Renaissance Capital. We do equity and bond investment banking and try and bring global capital to Africa. We've been there 10 years or so, and 5 years ago, I wrote a book called The Fastest Billion, talking about why Africa was growing so well. And what interests me today is still why Africa is doing so well, even against the headwinds of crashing commodity prices in the last 2 to 3 years. If we go back to the 1980s, GDP in Africa was running below population growth for a decade, which meant everybody, on average, was getting poorer every year. That's no longer true, even after commodities have crashed. And I think there's been a significant change, and finance has played a key role in that. So the first question I'm going to ask the panelists to address, the question is, where are we coming from? Where are we? Where are we going in terms of funding African businesses? And what strikes me is that if we go back to the 1980s, there was very, very little finance available for Africa. It was bilateral lending, primarily from Western governments. And when that was cut off or didn't happen, when commodities crashed, financing available for African businesses dried up. It's changed, I think, dramatically in the last 20 years. You've got the banks are bigger, can play a bigger role. Pension funds, investment kind of as a policy set up by Ngozi Okonjo-Iweala in Nigeria over a decade ago, can now play a significant investment role. We see that in Ghana, we see that in Morocco, we see that in Kenya. Eurobond financing. I get a question from a journalist about every 2 weeks saying, African countries have borrowed too much debt. Is this the next Latin American debt crisis? I don't think it is, but what I think is more important is that African sovereigns, corporates, banks can now issue bonds and have an alternative source of finance. Equity markets. 20 years ago, one of my clients went to Nigeria before it had a stock market. Now that stock market and others throughout the continent are another avenue for finance to get to Africa. So we've got bonds, we've got equities, we've got Eurobonds, we've got China. 20 years ago, China was playing no role of any significance, and now it's an alternative to Western lending, and local entrepreneurs. I think Dangote is an incredibly powerful symbol of change. 20 to 30 years ago, you made money in Nigeria or Kenya, and you might choose to put some of that into Knightsbridge rather than back into Africa. Dangote has changed that story And I think that's as important as the Ambani brothers in India in the late 70s and the early 80s, who did the same thing and pioneered what's now been a well-recognized Indian growth story. So I think those are some of the changes. I would like to get the opinions of the panelists as well. I've raised a few of the areas. Who should like to start in terms of what's changed? Yvonne, you're smiling.
Some of the other things that have changed, just to add to what Charlie was saying, sovereign wealth funds in Nigeria, Ghana, Kenya as well. One of the important things about the evolution of Africa's development is a lot of that money has to come from in-country, in local currency, and we're seeing a lot more of that. The insurance space, and therefore, and in addition, the asset management world, again, in the region, has increased over time. Just to add to the Eurobond space for African sovereigns, more and more we're working with African corporates to raise money in public and private markets as sources of funds. And as we all know, the money is available. I mean, we certainly are aware of at least $20 billion that would happily invest in Nigeria in public and private debt. It's not just Nigeria and Africa, to be frank. So the money is there. We also are aware of these pools of funds that we're talking about that could invest locally. There's also infrastructure funds that are coming up now in local currency in countries like Nigeria. So those are some of the things I would add, Charlie, to what you're saying.
And Faisal?
So we've come a long way over the last 20 years. If you just think about 20 years ago, it would have been predominantly about investing in commodities or US or aid going to hungry people. Things have changed significantly. We're going to talk a lot about infrastructure being a bottleneck, but let's focus also on the positives. Basic road infrastructure is there. Telecommunications has come a long way. That has enabled lots of businesses to invest. And that has enabled patient capital institutional investors to deploy money. And that's important. These are large amounts. Just our clients have more than $4 billion invested outside of South Africa. That's a large money. It's patient capital that can invest in growth, in widget makers, in supermarkets, and now even more so in more sophisticated areas like banks, technology, etc.
Harold.
A couple of things to add, probably. First of all, the remark that you made about debt issuance and the fear that there's too much debt issued. I don't think it is actually the case, because when you look at the debt issuance or the debt of many of those countries to GDP, I think it's still way below levels that we have in many Western countries. So I'm not too concerned about that. Secondly, in terms of funding into the region, I mean, there are numerous funds that are in existence. For example, on the agricultural side, where even Deutsche Bank is funding smaller investments through that fund, or on specific industries like on solar, where a lot is done. In addition to that, we apply many of the rules that we apply across the world in terms of financing. When you look at commodity trade finance, Africa obviously is rich in commodities, where you can take the commodities as the underlying to secure the financing. So that is an area that Deutsche Bank and other banks are active in. Then you can take the flip side, actually, where you look at the exporter side. So given that a lot of our clients have more and more interest in Africa, but have difficulties in financing that, or basically have the importer side covered to make sure that they are paid, there's a lot more ECA finance, so Export Credit Agency funded transactions where the Export Credit Agency from the respective country of the exporter guarantees 90, 95, and in some cases even 100% of the exposure, which in the end helps the importer country as well. So that's an increasingly important source of funding. And apart from China, I mean, I'm sitting in Dubai. A lot of Middle Eastern countries have become a lot more interested in Africa. It becomes a little bit the food basket of the Middle East, because in the Middle East nothing grows, as you can imagine, as opposed to Africa. So there's a lot more interest there. I would say, to the remark that Yvonne made about sovereign wealth fund, I find it actually a pity that, yes, the sovereign wealth funds are there, but I think a chance was missed over the last couple of years to build up the sovereign wealth funds in a much bigger scale than has been done in, for example, the Middle East. So the Middle East, given the low oil price, is now using the funds that they have accumulated over the past couple of years to now invest into the economy, to diversify away from gas and oil into agriculture, production, and what have you. When I look at the sovereign wealth funds in the region, mainly the oil-producing countries, it's a pity that they have not accumulated that wealth to make it able to diversify in a lot more aggressive way than I've seen in, for example, the Middle East.
Thank you. And Nicolas?
I think most of it has already been covered by the other panelists. The only thing I would add is, so CDC, we've been investing in African businesses for nearly 70 years now. And really one of our goals has been to create that market so that it would attract other investors into Africa. There has been a tremendous change over the last 10 years. 10 years ago, still there were only maybe a handful of funds active in Africa. And now we can count over 200. So this tremendous change, which hopefully will continue, and still a long way to go. And also a long way to go to attract other type of investors, especially earlier stage investors like venture capitalists.
If I could just address a couple of points. Firstly, my favourite new fact of the year came from sitting with the Sovereign Wealth Fund in Nigeria, so I should have remembered about the Sovereign Wealth Funds. And I was told that Nigeria helped seed finance Abu Dhabi's Sovereign Wealth Fund, ADIA, back in 1976, 77. There was Abu Dhabi saying, we've got no money, please help us. So Nigeria came along and provided them cash. It's amazing how the cycle can change over 40, 50 years. And secondly, I saw Bob Diamond speak a few weeks ago. He said that one lack of capital withdrawal in the last few years has been from European banks. Harold, you're working at a European bank. Is that something you've noticed?
I think you have to differentiate between the businesses that I just mentioned, ECA financing, commodity trade finance, and what have you. I am not sure there's a big withdrawal there. I would see a much more cautious approach when it comes to retail banking and SME financing. That I think is a much more difficult play for non-original African banks, because you have to look at Africa from a global bank's perspective as a portfolio. Africa is part of the portfolio. So it competes in that sense with Asia, Europe, the US, and what have you. And I think that is where the risk-reward in the retail SME is probably not what a lot of banks expected.
Just wanted to add, Charlie, just wanted to add that probably what Bob Diamond was referencing to is trade lines being cut with a number of banks in Africa. Yes, those trade lines were cut, but if we think about all the additional sources of funding that we've just mentioned on this table that have existed even during this slow growth to recession period in Africa, it more than outweighs the quanta of trade lines that have been cut during that period. And even retail banking, which a number of the international banks were doing with African customers, also in addition is relatively small to some of the additional sources of funding that we have. So the sources of funding is one thing that is an issue with Africa. I think we'll come later on to other issues like execution and regulatory issues, which is what's stopping the money from being employed in the region.
So I missed a few things in terms of where the financing is available from. We've got the pension funds, we've got the banks, we've got equity markets, we've got bond markets. I missed private equity, so thank you very much. I missed sovereign wealth funds and the trading finance and so on. Given that there is so much more financing, the next question we've been asked to look at is how will entrepreneurs get better access to financing? Do African businesses require unique financing solutions? And my base case is no, that we can take what's worked in development elsewhere, in Asia in the 60s or 70s, in Latin America in the 1980s. One of my favorite pieces I've written this year, I'm not very modest about my research, it was brilliant, was comparing Latin American policies in the 70s and the 80s and what we see in some countries or among some policymakers in sub-Sahara today. And luckily, I think a lot has been learned and a lot of mistakes are not being made. But we can take these experiences and bring them in. But how come I then get emails from entrepreneurs across sub-Sahara saying, can your bank help me finance my SME? We've got $1 million we need, $5 million we need. And at RentCap, we can't do that. We do bigger IPO type stuff, which tends to be considerably larger. So what's the problem for entrepreneurs? What's the problem with SME financing? And what can we do about it? If I could start with, who'd like to jump in? Nicolas, I'm going to let you start first this time.
Sure. So, I mean, there are two key things that, for me. One is to make sure we build up the whole investment ecosystem. And that includes investors at every step of the way of a business growth. So that goes from seed financing to angel investors, venture capitalists, private equity funds, and then institutional investors, etc. And also financial markets in general for IPOs, etc. So that is key, because once those pieces are together, then they can support business every step of the way, and also there's more visibility for investors for exit. The other thing I would say is with respect to financial institutions. In many countries in Africa, especially the smaller ones, the local banks really lack capital, and they are very attractive placements that can be made in government bonds, as was said earlier in a panel, in a keynote speak from the CEO from GTB earlier. So that actually is siphoning some of the capital that some smaller banks have, and therefore there's less available for small businesses. What we're doing at CDC, we actually we're keen in investing into local financial institutions, especially at the equity or quasi-equity level, because not only that provides capital to be deployed for businesses, including SMEs, but also increasing that capital base allows financial institutions to themselves borrow on the markets or borrow from investors, and therefore that has this multiplier effect. Venture capital is a very risky business. It's this earlier phase of a business where anything can happen, especially in technology or kind of innovation, which is what venture capitalists finance the most. And so when you add the risky nature of that business with the risky environment, or at least the perceived risky environment of African countries, then that might be a bit of a big challenge. Another thing which is tied to the technology is really the framework, the legal framework for intellectual property. Needs to be developed and strengthened around the continent, because that's where venture capitalists, as I said, invest mostly, and they want to make sure that this is protected. Another thing also is the exit. They want to see a clear exit and a number of options. So not only maybe a private sale, but some IPOs, etc. And the financial markets are being developed, but still need maturing there. The entrepreneurs in some African countries, they're looking at really building their business for themselves and their families, but not necessarily for beyond that. And what happens with a venture capitalist is that they expect the entrepreneur to make sure that themselves, the venture capitalists, make their money first and then look at themselves second. And so therefore, there's a bit of a shift in cultural kind of dialogue here that might be necessary. And finally, also in terms of culture, when venture capitalists meet entrepreneurs, they are looking at, okay, how can I make, a great return on my investment in your company? And then there's a tendency sometimes for this discussion to kind of go into a bit of a negotiation and haggling straight away, which sometimes puts some investors off, and therefore they don't take it forward necessarily.
Venture is a tricky asset class. We can argue that even Europe, it took Europe a long time to get their venture capital industry going up. If I take a step back, where is most of the savings? That's institutional savings within pension funds, insurance companies. If they want to deploy the money, they need the institutions and the infrastructure to be able to deploy that money, and there is a lot of interest. But I'm really super positive. If you just think about 10, 15 years ago, there were potentially only 2 stock exchanges that comply to the Tier 1 global standards. Today, there are a lot more stock exchanges. There are asset managers, there are private equity houses that adhere to best market practices. The banks are up and running. There was a mention this morning that there are only 400 companies with revenues of more than $1 billion. But that creates that snowball effect of those 400 companies increasing their initiatives, taking over smaller enterprises, and encouraging the entrepreneurism. So we're seeing that. We're seeing private equity funds trying to create larger companies by doing roll-up strategies, very sophisticated strategies being very successful in the Midwest and the US, and we're seeing very good evidence of doing that.
A couple of things I wanted to add to that. There's an emerging trend for homegrown, Africa homegrown, and international intervention funds that are very useful and available to entrepreneurs and particularly SMEs, particularly in areas like agriculture, technology, and some of the service sectors. So in Nigeria, the Central Bank of Nigeria, for example, has an agriculture fund. There's the Bank of Industries that has partnered with international and local firms to create SME funds available for SME companies. AFDB is doing the same. IFC is doing the same. In the US and in Europe, there are actually funds available to support growing businesses in emerging markets, including Africa. One of the important takeaways that the students here may want to do is the availability of the information of these funds in Africa and these sources of financing for these SMEs, which are much more relaxed and highly complementary to what the banks would be doing and actually prepare them to deal with proper banking relationships, is not widely available. So that's something that could be taken on by some of the people here. As strategic investors, so we've talked about venture capital and PE to a certain extent. I also want to bring strategic investors more and more looking at the region and are ready to invest capital directly in the businesses of these companies just to help them grow their businesses in the first instance and then create exit strategies where relevant. So those are some other things that I would bring to the table. Just one thing though, Charlie, about Africa not needing unique solutions. I think at a high level, yes, but when you drill down into the detail, the risk assessments are different. The local dynamics, like not having credit bureaus, not having track records, some of the risks, I often argue this point, you can only model African risk to a certain point. And at some point, you just need to take a long-term view. The risk management is tighter, But you cannot have exactly the same answers you have for the risk issues as you would have for an SME in the US, as you would have for Africa. So the application of the solutions ends up being quite different. And some of the other risks I'll talk about, for example, perception execution risk means you tighten the structures around how the money is dispersed, for example, in looking at the deals, or how you give access to money to people who don't have the track record. And that's where you find some more unique solutions that are needed for African businesses. The financial inclusion, which is a critical must-do for the sector, is something that will be very unique to Africa.
That part of Yvonne's answer, where she says Africa has to be treated differently from SMEs in America, you can hear the conversation she's had with head office Bank of America Merrill Lynch.
Many times.
And I hope you win.
Charlie, just one thing to add. As institutional investors other than the DFIs step into the kind of the larger scale, bigger investments, what's really encouraging to see is it's allowed the DFIs to change their remit. So many of the DFIs over these last few years have increased focus on investing in countries that are less liquid. They've increased focus, they've got special objectives to invest in smaller funds, to encourage the SME investing, which is also really good. So the DFIs can focus on the ground level stuff, whereas the larger long-term savings steps into larger African investments.
You've been patient.
Yeah, I was thinking how to answer this question when the other speakers were talking, because I think I have a slightly different approach when it comes to the answer. When you say, well, do we need specific solutions for Africa? Actually, I don't think so. And to a certain extent, I don't think that international banks, at least, can have different standards, because we are bound to international standards like Basel III, the regulatory environment that all the banks are under when it comes to money laundering, know your client. So we need a lot of information that is maybe not readily available, or maybe we don't get the right answers. So we can't deviate from those standards. So I would actually answer the question the other way around: is what can Africa do to get to those standards? And I think that for me gives the answer then whether banks can do more to help financing the region. And then it comes to, let's say, the regulatory environment, the enforceability of contracts in many of the countries, which is an issue. I think it's also softer, but actually harder, is the marketing of the good things that Africa has done. And this goes way beyond finance. I always see that I have a lot more explaining to do of why the business in Africa is good. Not many people know what is happening in Kenya on the IT side. Not many people know that Africa is leading in terms of innovation when it comes to payments or credit cards. Just geographically, when I was traveling to Botswana some time ago, people say, well, aren't you afraid of Ebola? And people don't know, have no clue where countries are, what the topics are. People talk about Africa, forgetting that within North Africa and Sub-Saharan Africa, 54 different countries with very, very different dynamics. So I think that is where Africa can do a lot more in how it is perceived. What I'm always saying within the bank is, because it's perceived as high risk, I'm actually not too concerned about higher risk. Risk as such, I mean, that's the job of banks. The more interesting question is how do you manage risk? And there again, I come back to two sides of that equation. One is you have to have a deep understanding of what is going on in Africa and understand the dynamics. So in that sense, yes, Africa is different from Asia, and Asia is different from Latin America and what have you. So that is the understanding, but at the same time, I would like to see a lot more efforts in terms of getting up to the standards that banks are bound to, as well as helping to change that perception.
We had the question, what are the most notable and most challenging experiences dealing with African businesses? And if I could just start off by saying one of the most interesting for me was bringing Bank of Kigali to the equity market in 2011 or so. I was taking a bank which had such a similar model to Georgia, in a country which had done massive ease of doing business reforms like Georgia. And then I discovered that it was indeed a Georgian who'd helped play a role in this. But that helped talk to investors and make them understand the opportunity. Because they could say, oh, well, this worked in Georgia in 2007. This could work in Rwanda in 2011, and it has continued to do so. So I found that kind of making those connections for investors who need a story has been kind of very interesting to me. I was just wondering about your particular experiences on notable and challenging experiences.
So first of all, our clients are long-term investors, so it's much more about meandering around challenges as opposed to challenges that stop things. But there are issues. There are investments in Nigeria, potential investments, very fast-growing businesses, and a lot of our private equity investors have also already tied down the negotiations. They're ready to hit the button, but the FX regime is a problem. And therefore, it is stopping currently, in the shorter term, new money from going in, and that's something that needs to be resolved. Egypt was an issue previously. And then there are smaller things which are much more around doing business internationally. So I just got a small example. One of our pension fund clients based in the African continent, $1 billion plus pension fund, it took 1 year to get through the KYC with a US custodial bank, and the problem it seemed to be was that the way addresses and zoning work was an issue that the compliance departments could get through sitting in New York. But those are small implementation issues. The larger issue currently certainly are these FX regimes and how these economies are run.
Nicolas, would you agree?
Yes, I mean, like Faisal, we at CDT will release challenges, so we always go after challenging transactions and investments. That's what we're meant to do. So I think your question about what's the most notable deal and challenging deal in Africa, or dealing, I think maybe the most notable is one of the latest. My specialty is project finance, so in December I closed a deal called Amandi, which is which got several awards as Africa Power Deal of the Year 2016. And power is very important for the economy growth and job creation, so I'm quite proud of that. But in terms of challenging dealings, I would have to say it's those transactions where we are creating the market. So where it's virgin territory, nothing's been done, and we are the first ones to invest. So in 2009, an example comes to mind when I closed the very first limited project finance transaction in Libya, in the real estate market. And that was extremely challenging. There was no legal framework whatsoever. So we had to do everything from scratch to actually make sure we could take the security that we could take and then perfect that security. So that was very challenging. And then after closing, obviously 3 years later, all hell broke loose in the country. So that was a different story. But then currently, I am working on another similar type of transaction where I'm working at investing in the first IPP, so independent power plant in Guinea. And we're facing the same challenges, and that's really what come to mind.
Like Nicolas, we also relish working on challenging situations. One of the challenges that we did enjoy, which is one of the most important transactions I think we've done is, I'm personally very, very excited about the growth in the insurance sector in Africa. I think it's where the banking sector was at least 10 years ago, and is going to grow at a much faster rate than the banking sector grew over the last 10 years. And so to advise AXA on their acquisition of Mansard, which is a first-class institution in Nigeria, and to help both institutions combine in a way that will change the face of the insurance sector for the long term in terms of just all standards and investment in the region was something very exciting that we did in 2015. It was challenging, but it was very worthwhile, and it worked. One of the other challenges of working in Africa that we've talked about, I think one important one is just I would say the erratic nature sometimes of the regulatory environment, and the manner in which we sometimes manage or not the perceptions of these things. So in 2016, we took a company, so we're very focused as an institution on helping corporates tap into the international markets, private and public. And we were taking a company whose main client is MTN, into the market. 3 days after we launched the deal, the Nigerian regulators announced this huge fine, which destroyed that deal for us. And what was worse was Nigeria's inability to really manage the communication around what actually did happen. So there's lots of good news, but I still think that the regulatory challenges, making it more investor and business friendly in Africa is a big area of improvement.
Thank you. Harold.
In the interest of time, I will keep it very short. So, again, I don't think this is different in Africa than in other regions, but bankers don't like surprises. Only like surprise with Christmas. So where banks are allergic is when information is not communicated in a timely fashion, and I think that's I would say one of the biggest things. On the positive side, where you see that things get done, is when there is a situation created where stakeholders are all on the same wavelength. This is not sub-Saharan Africa, but North Africa. For example, Deutsche Bank did a deal for a power plant in Egypt, which was probably the biggest export credit agency transaction that has ever been done, 46 billion. And that could only happen because both locally, internationally, politicians, bankers were all speaking the same language, and that stakeholder management was done in a very good way. So I would say stakeholder management on the positive side, sudden changes or problems on the other side. These are the two between good and bad.
The last question that we've been asked to look at is what factors prevent financial markets and businesses in Africa from optimizing their potential? And what recommendations do you have on the way forward? Certainly from my perspective, and it has been mentioned already, FX policy. FX policy in Nigeria, which may have changed last night. There's a new circular out from the central bank. For the last 2.5 years, I've been saying in 3 months it's going to get better, in 3 months. It keeps on not. But maybe it is now. But FX policy has definitely been the issue. You showed me 5 minutes. Is that 5 minutes to questions? Or 5 minutes? So I thought we had an hour.
We just take an hour.
Well, then there's no room for questions. I'm going to feel upset on behalf of the audience.
I would take it away from financials again. How can the continent grow? Like taking a step back, I believe that a country, a region can only prosper when you have a middle class in that country, because middle class normally drives prosperity around the globe. In order to enable prosperity or this middle class, is that you need to have education, You need to have good healthcare. And you need infrastructure. And the fourth one, which is necessary to enable the previous three, is a government that acts in the interest of people. And I think that is actually the most important one. Everything else derives from that condition, I would say. I leave it to you what kind of government form that should have. But I think that is actually less important than the will of the government to have to do the good thing for the people in their respective country.
If there is one or two questions that we can try and take.
Hi there. My name is Yemi, and I work in a Japanese bank in the UK subsidiary. My question actually touches on something you've all mentioned before. And the question is, who should be responsible for FX? And one of the reasons why I'm asking this is that a lot of you represent investors that have an FX concern. So a local company that is perhaps 95% trading in Nigeria might not worry about FX so much. But to a foreign direct investor, the two functions of your return is the foreign currency return and the asset return. And in Nigeria, as an example, over the last 2 years, the foreign currency has plummeted 50%. So without taking inflation into consideration, you'd have needed a 100% return over 2 years. If central banks in African countries do not have the foreign reserves or the resources to be able to manage the FX in a way that gives comfort to foreign investors, who do you think should step up and solve those kinds of problems?
And perhaps we'll take one more question as well, and then we can address it perhaps from that lady in the middle, and then we can address either and both through the panel.
Hi, my name is Faye. My question is, what is the current state of corporate governance for financial institutions and invested companies in Africa? What does the medium-term state of corporate governance look like? And how do you ensure that you can remain flexible, as I presume you need to be in Africa, while still making sure that your corporate governance does not suffer?
Did everyone catch that?
I'll just start off with a few words about both those questions. Let me just put out the problem with FX. It's not about volatility or falling FX. We've seen what's happened in Brazil. We've seen what happened in even South Africa. The issue is uncertainty. Why new money struggles to go into Nigeria right now is because people questioning whether within the next 2 or 3 months the Naira is going to be 30% lower. I think that's the issue. It's not the fact that a currency could depreciate, it's the uncertainty around that. On corporate governance, really, by the time the likes of CDC get through all the diligences and processes they put in place, the companies that attract institutional investment typically tend to have better corporate governance than many European equivalents. So corporate governance is something that there's a perception issue, but certainly when you're actually investing money, it doesn't tend to be as much of an issue.
I would take the question about who's responsible for FX policy. In every country, there's only one party, it's the central bank. And anyone else who's trying to intervene in that space actually is creating more interference into a complex situation. It's the central banks always.
Anybody else?
Well, I think
Go on.
No, I think Faisal answered for me, actually, so thank you, Faisal. But so just two more points to add. So when an investor invests in a business in Nigeria, for example, where they, an official interest rate and an unofficial interest rate, straight away, there is a risk that they could lose that percentage, that difference, like could be up to 30% straight away. So how to kind of, make enough money to recoup that, that's very challenging. And then, yeah, I would just confirm that one of really the objective of CDC when investing in business in Africa is actually raise the standards of all investee companies for us and really guiding them through the corporate governance objectives. And we generally set a plan of action over several years to help them raise the standards from current level to where we want to go, and hopefully even better than Western standards.
My name is Zainab, and I work for ICBC Standard Bank. My question is around the regulatory framework. How do you think a lot of the African countries can improve the regulatory framework to attract more investors in the country? Because I think it's sort of like a stumbling block for a lot of investors coming into the country to invest.
Pension fund regulation and insurance regulation could be much better. There are local pension funds in African countries across the board who want to take more equity type risk. They want to invest in neighboring countries, but they cannot. That actually inhibits investment towards growth investing. So any regulation that encourages regional investment into growth-seeking assets is always going to be, is really, really required.
What came up in the conversation was that perhaps ECOWAS could be used, or the East African Community, or SADC, to enable portfolio money to flow more easily. Tanzania is having a real problem IPOing a telecoms company right now, because it's just for the domestic Tanzanian base. But why shouldn't Kenyans be allowed to bring as much capital as they'd like if you're part of one East African community? And the benefits for Tanzania would be more value on that company, more liquidity in their market, so on. So perhaps there's scope for broader, good regulation, which is regional. So at the front, you've been very patient. Thank you.
The panel, why Chinese banks don't see what Western banks appear to see. When Western banks were withdrawing from African trade finance, Chinese banks were coming in. Why is it that they see something that Western banks don't see? Or they don't see something that Western banks see? Secondly, one other short thing. In the equity, something that looks like venture capital or equity market, Afrexim Bank has done some experimenting with asking branded hotels to partner with local hospitality companies to set up hotels that bear franchise names. Okay. It hasn't worked very well because the franchise companies want returns that do not fit into the...
So I'm being waved at, so I've got a very short amount of time, but do jump in.
Okay. On the first question on the Chinese, yes, we're pressed for time. A quick story. A couple of years ago, I was at a conference where there was a historian talking about exactly that topic, Chinese and the Western world. I think the answer lies into the short-term thinking of the Western world as opposed to the long-term thinking of the Chinese. It doesn't mean that the Chinese don't want to have a return on their investment. It's just a time frame they look at that return, which is not next quarter, it's not next year, but it's in 50 years or it's in 100 years. And he gave that perspective with the story that he said, well, look, the Western world thinks they are far ahead of the rest of the world. That's where a lot of the wealth is and what have you. From a Chinese perspective, it's very, very different. The Chinese, they basically were ruling the world or were very influential in the world for the last couple of thousand years. For them, they say, well, we missed the Industrial Revolution 200 years ago, or whenever it was. So for them it's a blip, but they will come back and they will look at the continent at a time horizon of the next 50 or 100 years. But I mean, just as a word of caution, I think Africa or whoever deals with Chinese or any investor, they will wait for their return. It's just a different time frame.
I would add something else to that. The time frame is different, and the return requirements are different. So the Western world is looking more at dollars and cents. The Chinese primarily have a more long-term strategic view on resource control. And that means that and resource control and managing their own employment labor situation amongst other criteria. So what that means is the way that they would respond during different economic cycles will differ from how individual Western institutions will to the same scenario.
I was going to invite people to just give a last 2 words on what they want to see in the next 2 years. What's the most important single change? 5 words or less.
Business-friendly and investor-friendly fiscal policy across Africa.
2 words, Ms. Guru? Anyone?
For me, it would have to be infrastructure, especially transports and logistics and value chain infrastructure, because that has such an impact in terms of trade and investment throughout the economy.
Harold?
Maybe not 2 years, but so the microphone is maybe not 2 years, but a longer term, and actually that's where you all come into play. And it is that everything that we have discussed and the more fundamental changes that the region has can be changed by all of you. You are the future leaders, both in the industry, innovators, politicians, what have you. So you can change the way we think is the right thing, and actually I don't think we have said anything really new. It's just a question of execution. All of you can do that in the future.
Faisal, 5 words.
Continued improvement into existing infrastructure, better liquidity on stock markets.
Thank you very much indeed. Can we just give a round of applause to our panelists?